Welcome to California in Focus. I'm Aliana Kernodle. California's Legislative Analyst's Office now says unemployment insurance taxes on businesses must rise by 2,117%, nearly a year after declaring the state's unemployment benefits programs, quote, structurally insolvent. Joining me to tell us more about this is the Center Square's Kenneth Schrupp. Kenneth, can you tell us about this report?
Hey, Aliana. This report outlines what drastic actions the state has to take to make its unemployment insurance benefits fund solvent again. During COVID-era lockdowns, the state issued $55 billion in fraudulent unemployment benefits claims because they automatically approved every application that was sent in. This resulted in the state requiring a $20 billion loan from the federal government to cover these fraudulent benefits and a $1 billion annual interest payment on this loan. The state is not paying down the principal and is just paying the interest, meaning it's just kicking the can down the road. This is a real problem for California and its businesses because every single year after 2 years of the loan not being fully repaid, California's payroll taxes for unemployment insurance automatically go up by about $400 million a year. So over time, payroll taxes are going to continue to rise until this is somehow paid back. Except these increases won't be enough because the state's unemployment fund already runs a structural deficit of $2 billion a year, as in people are taking out $2 billion a year more in benefits than what people pay in these taxes, which means the state has very little choice now but to raise the taxes to make up for this massive fraud during COVID.
So what does this mean, like on a employee, on a business level?
Okay. Normally, a California business would pay $42 per employee per year in this payroll tax for unemployment. That's 0.6% on the first $7,000 of wages paid. In 2025, each employee will cost $105 in annual payroll taxes because of a $21 per employee per year increase after those 2 years of unpaid federal debt from the state. However, this $105 could soon rise much higher. The state's Legislative Analyst's Office, a nonpartisan state-funded research branch, says that the state must raise this threshold from $7,000 to $46,800. This would increase the payroll taxes per employee making $46,800 or more per year from $42 to $280.80. However, the LAO says that this alone is actually not enough to address the state's solvency problems. So it suggests raising that base tax rate also from 0.6% to 1.4% on a regular basis, and an additional 0.5% when the state needs to build more reserves for its unemployment insurance system, which has no money in it. So you'd have a 1.9% total rate on a higher threshold going from $7,000 to nearly $47,000, which would see the payroll tax rise to $889.20 for every employee making the threshold or higher, or over 21 times higher than the existing base payroll tax for unemployment.
And the LAO has some other recommendations as well about perhaps making adjustments for different sizes of companies. What are their suggestions there?
Right. They say the state should look into having lower rates for companies that have growing headcounts and are hiring more people, because it suggests that these companies are less likely to have claimants under the unemployment insurance benefits program. If you're hiring more people, you're probably not firing as many people. And they also suggest refinancing the state's $20 billion loan from the federal government for these fraudulent benefits. So LAO suggested half of this loan could be refinanced with a new bond that's going to be paid by employers, and the other half would just come from a refinancing or or repurposing of assets from the general fund, which of course also still includes employers.
And you mentioned earlier that a lot of this arises from policies during COVID. Who was behind these policies?
Well, the buck stops with California Labor Secretary Julie Su, or at least then Secretary Julie Su, and Governor Gavin Newsom. They decided to automatically approve benefits applications during this time. What's interesting is Su was appointed as U.S. Deputy Labor Secretary under the Biden administration in 2021. So after rolling out this fraudulent benefits spending, she was elevated to the federal government at the second highest position in the Department of Labor and was elevated to acting U.S. Labor Secretary in 2023. However, because of her record in California, not even the Democrat-controlled Senate was willing to confirm her. So she's been in a acting, unconfirmed capacity as U.S. Labor Secretary. In that position, she's been trying to waive California's $20 billion loan from the federal government that she was responsible for incurring.
Well, Kenneth, thank you for your insights on this story. Listeners can keep up with this story and more at thecentersquare.com.